Starting my speech in 5, 4, 3, 2, 1. Mr. Speaker, ladies and gentlemen, I have a very simple question. Over the past 100 years, who has made safer and more profitable investment decisions? Is it the average finance bro trader on Reddit and social media who represents Main Street? Or is it the largest domestic and international banks like JP Morgan, Credit Suisse, SBI, HDFC, etc.? Wall Street has historically and statistically done what the 99% of people can't do, precisely because they have the capacity, the technology, the motivation, and the information to make the best decisions. Opening government is largely simplistic and uncomparative of each other. Opening government successfully talks about capacity and oversight. Opening opposition attempts to respond by running a case that champions that the average Joe should have access to it. But my very simple response to take out depth from this debate is that that's a trade-off we're willing to make, bro. Not everybody should have access to capital precisely because they might be unable to pay back. That harms them because they get money and incur a liability, and it harms the very people who put money there who eventually end up losing money. Uniquely coming from closing government, our path to victory is simple. Number one, how do banks better enable economic stability as opposed to standard financing, and how do they guarantee longevity? This is something Opening touched on, but I'm going to run a vertical case that makes the middle analysis. Number two, how do banks ironically democratize finance for the average Joe through the main banking system? And I'm talking about like savings accounts that can actually debit funds and be able to invest in things like direct placements, exchange trade funds, mutual funds, time deposit. This is a direct response and flip to Opening opposition. And third, I'm going to talk about the heart of this debate. What exactly is financing even for? Because the biggest part of this debate is that how are you able to serve your debt obligations and pay back the money you borrow? Opening was largely a debate about, do we prefer the banking sector and industry over capital markets, stocks, and direct placements as a means of raising capital? We're going to talk about loans and specifically how these businesses who borrow are more positioned to be able to execute their plans and have better oversight through the main banking system. First, what makes banks more stable than standard financing? A, the number of specialized decision makers. On-site government, we have thousands of staff, analysts, and all of these specialized individuals who get hired from the best schools around the world, who literally have their job to do things like investor relations, due diligence, and network. That is as opposed to individual mom and pop shops, traders, and industries on side opposition, who we think get a lot of their research from hearsay, from Reddit, from social media, from vibes, from what they think is actually going to go up. But I'll be charitable. This is me responding to what CEO brought about in a POI, which I think is fair, that these guys also have access and capacity to do research. Very simple question. Where do these guys get their research and annual reports from? Bro, it's from the bank themselves. When the bank has their quarterly state of the market updates. And we think these particular banks, because of what the info slide mecked out, actually has a more direct proximate control because they're the ones investing hundreds of thousands of dollars in those businesses. It's not like these businesses will be like, hey, 10,000 shareholders, what do you think? Here, tour my factory. No, at best, they have an annual shareholders meeting where they give you wine and steak and tell you all the good things you want to hear, so you invest more money. As opposed to when they deal with the main banking sector, wherein they directly have to prove it, or else they won't be able to get access to their loan and do things like that. The second thing is about how banks democratize access to finance through the main banking system. Banks can offer direct products like A, direct ETFs, mutual funds, and exchange funds that actually serve as a feeder fund to be able to directly expose yourself to other markets. Like in the Philippines, for instance, we now can invest in the Indian market, we can invest in the S&P. 2, international and domestic bonds, of which a lot of retail individuals around the world don't fully understand because of a lack of financial literacy. A lot of these opportunities are simply enabled only for the wealthy who understand this shit and can get wealthier, but uniquely banks create these foolproof products to be able to do it. C, things like money market instruments and time deposit that actually give you a chance to be able to earn above an average savings account rate as opposed to having to do all of this complexity yourself. In fact, banks also have applications, websites, and all of this infra to democratize and give people particular access. Before that, whoever raised their hand, go for it. Fam?
Wonderful. Understand when we talk about these, shareholders, this also includes private equity, and these firms probably have better, sort of research teams and access to technology, etc., because that's literally their job. They are there to
100%. The answer to that is a lot of these PE firms are after a bagger. Hey, brah, we raised $100,000 pool. How can we make that 50 or 100x? And that's exactly why a lot of mom and pop, even the best PE firms, eventually end up getting absolutely wrecked because they make all these YOLO bets on what opening opposition says are mom and pop businesses, small businesses. We want this regional representation. That is the path, ladies and gentlemen, to bankruptcy. So, if I am a firm trying to raise capital, I rather work with a bank who is able to give me a direct credit line as opposed to going with private equity who tries to get a sense of control ownership because they want to own stake in my company to have influence as opposed to a bank who just wants to give me money. So, from the perspective of a firm off which this motion is set, it's in your interest not to lose a control position when private equity firms, the ones who you're talking about with venture capital, regardless of what seed of funding, are there to take the biggest bite to be able to have control and have proximate interest over you. Let's say they do it properly well. What they want to do is they're going to acquire ownership and then they're going to sell you right away to be able to make a return on their money. That's exactly how VCs and private equity work. Uniquely, what do you get coming from our side? You get this comparative and idea that we're able to protect the firms trying to raise money at better interest rates to the bank, and we're able to flip what opening opposition said. The average person who wants democracy and access to this, when we give them a chance to do that through the bank, through a conduit. And with this, we are very proud to stand on side government.